Good morning, everyone. Welcome to today's meeting of the Local Pension Committee. As usual, this meeting is being broadcast live to the public. For those not able to watch live, a webcast is being recorded, being made available for viewing on the County Council's website after the meeting. Before we begin, can I remind everyone to only turn on your microphone when you wish to or are invited to speak. We've received apologies from Councillor Dave. I've been asked if we can have a round of introductions because of faces, and I think we're actually, apart from Councillor Dave, it's a full turnout, so it's quite a lot of people here. So for those who don't know, I'm Councillor King. I'm County Councillor for Cartry Division. I'm Chairman of the committee. It's on to Mr. Grimley.
Thank you, Councillor Daniel Grimley. I represent Burston Ward for the Council, the Vice Chairman of this committee.
Hello, Rupert Sims, newly appointed employee representative to the committee.
Hello, Nick Booth. I'm an employee representative of the committee.
Simone Hines, Assistant Director of Finance at the County Council.
Louis Hill from LGPS Central, your Client Director.
Theory, Responsible Investment Analyst for the Fund.
Hi, Balash Katra, Finance Business Partner for the
David Walker, Investment Consultant from Hymes Robertson.
Declan Keegan, Director of Corporate Resources at the County Council and Responsible Officer for the Fund.
Hi, Ripple Betcher, Employee Representative on the committee. Councillor Martin Cartwright, Hinckley and Bosworth Borough Council, elected to but represent the district.
Roy Denny, Chairman of Blaby District Council, also representing districts.
John Bloxham, County Councillor.
Good morning, Ian Howe, Pensions Manager for the Leicestershire Fund.
Good morning all, James Henry, Director of Finance at Loughborough University, and I'm a university representative.
Bill Piper, County Councillor for the Division of Port Nestle.
Morning, I'm Patrick Taff. I'm an Assistant Head of Law in Legal Services in the County Council.
Smith, Democratic Services Officer.
Okay, thanks for that, everyone. So that's on the record, and so we'll move swiftly on then to item 1, which is minutes of the meeting held on the 5th of December 2025. That's pages 3 to 20. And I'd like to move that the minutes of that meeting held on the 5th of December taken as read, confirmed and signed.
I'll second that.
Okay, so that's been proposed and seconded. Is that agreed by those who are present? Agreed, that's agreed. So we move on to item 2, which is question time. I've received no questions. Moving on to item 3, questions asked by members under Standing Orders 7.3 and 7.5. No questions have been received. Item 4, agenda item 4, there are no urgent items. Item 5, we have declarations of interest. Do any members have any interest they wish to declare? Okay, no one making anything, but obviously if during the meeting you realise you ought to declare an interest, then please don't hesitate to bring that to our attention. So then moving on to the first substantive item, which is item 6. This is the what Natalie called cessation corridor approach, draft funding strategy statement, pages 21 to 104 of the agenda pack. And I'm going to invite Ian Howe, who's the pensions manager, to present this report. Also welcome Stephen Tart, Richard Warden from Hyman's Robertson, who have joined us online for this report. So welcome to you. And Ian, over to you. Thank you.
Thank you. Yeah, I was going to present the report and then I'm to hear if you've got any questions. As part of the valuation, as members know, we also have to look at the funding strategy statement. We've been out to consultation and we're working through the employer replies on the FSS. One element of the FSS is what we call the cessation calculation methodology, which is when an employer leaves the scheme, how we assess that period in terms of calculating that cessation. In the 2022 valuation, we introduced a kind of an approach that slightly changed it. So we moved it to a risk-based likelihood of approach, and we used a 90% likelihood, and that's the likelihood level of future investment returns on the low risk basis, achieving the value over a 20-year period. Now we've looked at this since 2022, and the position is improved. Funding position is improved, as members know. So we're proposing to change that approach slightly. So we'll still keep the risk-based, but introduced what we call a bound, so an 85 to 95% approach, thereby helping the employers, but also holding more back for the fund in the period of time when we're in surplus. So therefore, the idea being, if an employer on the 85% leaves in deficit, then they will still make good the payment, as they would do currently on the 90% approach. But if an employer leaves on the 95%, then the fund will consider making payment back on an element of the surplus. The fund then determines how much of that surplus is payable, looking at different elements already within the FSS. That bit isn't changing, and the regulations state which elements we look at, and then an element of that exit can be paid back. If it's between the 85 and 95, there's no payment back from the fund, or indeed no payment from the employer. So it's to sort of spread the risk a little bit, to assist employers on the lower side, but to also support the fund on the higher side. The intention is to bring this back to committee in March with the final changes to the FSS, alongside the final valuation information that will be taken back to committee for approval at that point. So this is really just at this stage, just for noting. But any questions, please feel free, and Hyman's are here, as I say.
Okay, Councillor Cartwright, sorry.
Thank you, Chair. Just a point of clarification on it, if I may. Assuming that somebody's wishing to leave the scheme, are they able to apply to see where they fit within the 85 to 95% rule? Because that may or may not change the decision to go ahead and leave. So what is the process for discovering prior to pushing the button to leave, to find the difference between the 85 to 95% rule? Thank you.
If I may, just to be clear, this is employers leaving the scheme, not employees. Right, okay. Thank you. Ian? No, okay. Ian? Thank you.
Yeah, I think if an employer was interested in leaving the scheme, we'd be working with the employer as part of that exercise. So we'd work through that. I guess we'd provide information in preparation of that to assist the employer in making that decision. I don't think the fund would hold an employer back who wants to leave, accepting that would have implications on the scheme members themselves. But if the employer chose to do that, as long as I think it was dealt with properly under the rules and the fund were happy, then I think we would work that way. I think that's reasonable.
Okay, Councillor Cartwright, you happy with that?
That's fine, Chair.
Okay. Councillor Danny, did you have a question?
Please. A dirty word really, but local government reorganisation. I mean, most of the authorities will cease to exist as such. There must be some mechanism whereby there's some continuity there. Perhaps you can enlighten me.
Ian, do you want to pick that one up?
Yeah, certainly. There will be in employers ceasing without any question. I think for local government reorganisation, what we would do is we'd still have to, under the regulations, do a cessation valuation. We have to do that. That's the rules and the regulations. And then I think what we would do is then look to see what is happening to those members. Are they sort of moving to a new authority, or are they being split across various authorities? And then we would work with the actuaries to move the assets and liabilities accordingly.
Okay.
Thank you. Sounds like a big job.
Yeah.
Okay. James?
Yeah, the question relates to this item, but I think possibly a little bit broader in terms of the kind of funding strategy statement. I guess, is there a thought process or a principle that when kind of the valuations markets go up and down, we shouldn't necessarily use that as a way to adjust assumptions and kind of risk profiles. And I guess I'd kind of be kind of thinking that when in the downside, if kind of the markets have gone the other way, we wouldn't de-risk some of these assumptions to kind of to protect kind of things like employer rates. So is that a thought process? And I guess thinking about other similar funds, I don't believe they're taking this approach. So West Midlands, for example, and just I guess just some of the thought process behind that and maybe why it's playing out differently in different places.
I think other funds are doing this. We're aware of that from Hymans. Hymans have told us that. I don't know whether West Midlands are or aren't, to be honest. I think when the times have been not so good, so we were in deficit not that long ago in pensions perspectives, I think we were very reasonable with employers. We didn't put rates up significantly. We built them up gradually to protect the employers during the bad times, but also we needed to get to a positive position. We are in a strong position now, the best we've been, and I accept that's a great position to be in. So we're trying to protect both the fund and the employers really, because we want to retain some of the surplus. So when the bad times do come again in the future, we don't want to then have to sort of push employer rates back up. We'd rather protect the employers at this point. I guess an employer's hat, they want to get the best they can, and I understand that, but I think we've got to look at it from the fund's perspective as the broader view to protect the fund rather than individual employers within that, and that's my take on that. But I welcome Hyman's views as well.
Okay, have we got anyone from Hyman's on the call who can answer that question?
Yeah, I'm happy to take that one, Chair. Yeah, Ian's spot on there. I was thinking back, we've had crises, we've had market crashes, market rises over time in the pension fund, and if we go back to the credit crunch, and you might remember those who were around at that point, we had a big gaping deficit, not just in the Leicestershire fund, but elsewhere. There wasn't an overreaction to that. Rates did go up a bit, but we're a long-term investor. There's a long-term funding strategy for virtually every employer. So the aim of the game here is when you've got a nice surplus, Ian's right, you want to retain some of that, give some back, but not go rural on rates. And equally the other side, when you've got a yawning deficit, the expectation, hope is over the longer term that will recover, so you don't put too much pressure on employers. You get a bit, so you're kind of getting this balance between it's protecting the fund but giving something to employers, but they meet the balance of the cost. So sometimes you pay a bit more, and sometimes you pay a bit less. And the mechanisms and the kind of approach in a funding strategy aims to achieve broadly stability over time. That's the aim of the game, in pension funding. And so that all the work that goes into this, we're in a more uncertain fund environment. At this valuation, so you'll see the prudence has gone up a bit. Surplus is still a strong fund position, but a bit more prudent in an approach, because as Ian rightly says, the bad times could come, and this stuff hasn't been banked yet at funding level. We made an assumption about future returns, that's not been banked, so we don't know until 20 years time whether that will be true or not. This is a set of assumptions. So.
Okay, thank you, Richard. James, does that help? Does that help you? Okay, Mr. Piper.
Thank you, Chair. I just wonder whether or not this is an opportune time to do this, considering the local government reorganisation, whether it's best to do it before or whether it's best to do it after the dust has settled afterwards. I'm just concerned that if we do it before, and we go through this, and then we go through the local government reorganisation, whether or not we might then have to come back and revisit it afterwards.
Ian?
Yeah, the regulations state we have to do a cessation. We have to. So whether we do this under this methodology or the previous methodology, we still have to do it. And we will still have to then sort out the assets and liabilities to wherever those employers end up, or how those members ultimately end up working. So I don't think this particular point changes that, if I'm honest, because we will still have to do it. This is just on a slightly different methodology. So I don't think that really makes any difference in truth. Right.
Okay.
Sorry to just add to sort of what Ian said about
Yeah.
reorganisation, because it's the mechanics of reorganisation will mean that the future sort of unitary authorities still legally have to offer LGPS to all the staff, so that element won't change. In some kind of the machinery of government means that all the kind of the assets and liabilities of the existing authorities have to transfer to the new successor authorities. So it's a big administrative exercise for Ian, but actually on the surface for the fund, it's not really going to change anything. It's all sort of behind the scenes.
Okay, thanks, Declan. I was just going to say, it doesn't alter the fact there's still a pension fund that's still got to be administered, and what the name of the employers are from the local government side. That's basically what LGR is about. It's still a scheme. It's not going to disappear and be broken up. Nick.
Thank you, Chair. I'm supportive of this proposal, Ian, because what you don't want is just at the time when the fund is doing well, the employer cashes in its chips effectively, takes the money, and then the existing employers and the fund then take the risk. And that's not what we want to happen.
Yeah.
So I'm supportive of the idea behind it. A couple of technical questions really behind it. Are there any chances of somebody trying to do it under the old policy and trying to slip it in before we have the new policy, assuming that is approved? And the other bit is, let's say somebody's over the 95% at a particular point in time, but when you actually come to do something in 2 or 3 months' time, once it's gone through all the procedures or whatever, it isn't. How is that taken into account? Is it one particular point, or is it other points taken into account, if you know what I mean, Ian?
Okay, Ian.
Yeah, the actual calculation is very clear under the regulations. It's the date that employer leaves. So the point you raised is a very fair one, Nick. You could be in a very positive position, and then a month or two later, it's not so positive. But the date that it triggers is the date the employer leaves. So that is set. I don't anticipate any employers that potentially could be leaving currently challenging this. I don't think. We're working with some employers currently who are looking at options, but the FSS, if approved on the 1st at March 26, will come into play from April to align with the period of the next valuation. So depending on when that employer then leaves, if it's after April, it will be under the new FSS, Nick. All right.
Okay, happy with that. Okay. Did you, Mr. Rupert, is it? Yeah, okay, right, Rupert.
You almost answered my question there, Ian, but I just was curious to know how regular an occurrence it was that employers left, and whether there was an anticipation that LGR, has been mentioned a couple of times, might trigger additional departures.
Employers leave the scheme all the time, in actual truth. There's different categories of employers. So we have an employer group called the transferee admission bodies, which is a specific group who have a contract end period because they're due to outsourcings from previous authorities. So it's based on the contract length. So they are leaving all the time. So this is a process we work through regularly. It's very, very unusual though for a larger sort of, dare I say, a statutory body. They're not all, but more of a statutory based body to look to leave. That's pretty unusual, I will be honest. In fact, very, very unusual actually. But the transferee admission bodies is much more regular. Is that all right?
Yeah. Okay. Did you? Thank you. Mr. Councillor Cartwright.
Yeah, listening to what's been said, is it just to put my mind at rest, is it not just a fairer way of looking at this, that the 90% is what is already agreed and nobody's had any pushback on that, and that's been in place for some time? This just makes it a bit fairer for those that are above or beyond that by the change of it. So fundamentally nothing changes, it just makes it a bit fair. Is that not a better way of looking at the proposal?
Ian?
Yeah, you could say that, yeah.
Okay. All right, so I think we've had a good A lot of questions about that, so thank you for that. Committee is asked to note this. Note the proposed change to introduce a corridor approach for the fund cessation methodology, and that the fund's final funding strategy statement will be brought to the 20th of March pension committee meeting for approval. So so we'll get the final one then for us to agree. Is that agreed? Yeah, that's agreed. Thanks very much. Yes. Yeah. Yeah. Okay. I'll ask, does anyone disagree? Okay. So we're going to move on now to item 7. So this is more of a lengthy item. This is the overview of the current asset strategy and proposed 2026 asset strategy. This is pages 105 to 236 of the pack. And I'm going to ask Bullish to present the report. I'd also like to, well, David Walker's here. He already introduced himself at Hymans, and he will also be delivering a presentation as part of this item. So over to you, Bullish and David. Thank you.
Thank you, Chair. I'll take a few moments to introduce the paper before we kind of get to the meat of this presentation. So this is the annual review of the strategy, and the purpose is to inform the committee of the outcome of the annual review of the fund's strategic asset investment allocation. The report also provides guidance regarding the fund's approach to local investment as required by government's draft regulations, as well as the approach to engagement and divestment. Chair's already mentioned, David is here from Hymans who will present. We've got 4 appendices attached to this paper. The 2 big ones are the first one, which is Appendix A, our portfolio structure and performance. So we'll get a presentation on that, and then the kind of the main part, which is the details regarding why we've decided to recommend the changes as part of the 2026 strategy. I'll go through a bit of background. The fund's liabilities are long-term. The strategic investment benchmark is structured to reflect the nature of those liabilities by focusing on the need for long-term returns and a degree of inflation-linked returns. Market fluctuations and timing of commitments will cause the fund's actual asset allocation to vary from the agreed strategic asset allocation. The strategic benchmark, which is set each year, should therefore be considered an anchor around which the actual asset allocation is managed. We've got a bit of background at 5. The fund has improved its funding level over successive valuations, as at the last valuation, the 31st of March 2025, shows a funding level of 140%. Essentially, every pound of liabilities is supported by £1.40 of investment assets. And we've got some numbers here for previous valuations. So at 2022, we had 105, at 2019, 89, and at 2016, a 76% funding level. The committee was updated regarding the whole fund actuarial outcome at the 26th of September meeting. Overleaf on page 106, we've got the main assumptions which were agreed at that point. So the discount rate, CPI inflation rate, and the salary increases. So all of those assumptions support the 140% funding level. The funding level has largely been driven by an improved investment outlook. So that's due to a rise in global interest rates leading to higher expected future returns across all asset classes. It is important to note that future investment returns are not guaranteed, and whilst there has been a significant improvement in funding levels since 2019, the fund should still remain prudent to protect the position going forward. 8 and 9 talk about the fund investing with our pooling partner, LGPS Central. I won't read those out. Number 10 talks to the amount the fund is invested with Central. So as at the last point, 30th of September 2025, the fund was valued at 7.1 billion. About 62% of that, so 4.4 billion of the assets were invested with LGPS Central funds. And we've continued to make commitments to LGPS Central, so that 4.4 billion will rise in time. And we have about nearly £1 billion worth of uncalled commitments to Central products. 11 and 12 talk about something we've probably talked about regularly over the last couple of years. The decision on the appropriate investment allocation to each asset class is difficult and is dependent on a trade-off between expected risk and investment return for each asset class. Whilst historic outcomes for risk and return can be informative about how asset classes are correlated to each other and may perform in the future, they give no guarantee that these historic links will persist. And 2022, as at point 12, is a reminder of this. 13 to 18 describe last year's strategic asset allocation, so that's 2025, the changes that were proposed and the actions that were taken. Point 13 summarises the 3 changes that this committee made as at this meeting last year. So that was a 3.5% increase to listed equity, so taking that to 41%, a minus 2.5% change to property, taking that down to 7%, and a small 1% reduction to global private credit, taking that to 9.5%. The table at 14 summarises the main asset classes. You'll see they've been grouped into 3 boxes: growth, income and protection. And it's a good way to kind of show where we're underweight and overweight versus the strategic asset allocation for 2025. Mainly, if you look at the middle box, we're underweight most of those asset classes there. So infrastructure, underweight by 2.3, global private credit, underweight by 2.7, and global credit, liquid MAC, underweight 2.7. All of those underweights are reflected by the overweight we have in cash. It's not to say that we've left that. What we've done is we've made commitments, but those commitments to these private markets take time to be called. And in the meantime, that money sits in cash. And 3 asset class reviews are also planned for 2025. A tail risk protection review was scheduled for the end of 2025. A review of property and private global credit asset classes with the aim to maintain exposure to both, as well as take into account pooling. The private credit and property reviews were presented to the 1st of October 2025 meeting with the investment subcommittee, and the tail risk review commenced earlier in 2025 with the scope agreed, but owing to the complex nature of that investment and the likelihood of it taking longer than the 31st of March 2026 to design a solution and implement it, alongside the fit for the future guidance, meant that it was something that it was prudent to pause and then reassess again in the following years if it was a suitable option. Investment frameworks for both private credit and property were reviewed, and where appropriate, commitments were made at the 1st of October meeting in 2025. In summary, additional private credit commitments of 120 million in aggregate was approved to existing central private credit vintages. Points before I move on to the 2026 review. Any questions at that point?
Anyone got any points on what I've heard so far? No? Okay, so we'll move on to the next section, please.
19 to 43 covers the 2026 review with the recommendations at point 45, which we can return to after the presentation from David. The scope was agreed for this review in 2025 with officers and was communicated to the committee in December at the 2025 December meeting. The main points to be considered are a general investment markets update, which is our first presentation, a review of the investment strategy using asset liability modelling conducted by the actuarial team for the 2025 actuarial valuation, so essentially how probable the strategy is to be able to meet the required investment return, commentary on the role of protection assets, noting the strong funding position, local investments, and then mapping of the current strategy and any proposed changes to the 9 new asset classes which government have advised as part of the Fit for the Future consultation. Won't go into the meat of it, but I think this is probably a good time to hand over to David.
Okay, thank you. Over to you, David, then.
Just queue up the slides. Just going to stick slides on, just bear me a second.
So just while Felicia's loading up the slides, I suppose there are 4 appendices, and I think each of them reflect 4 key areas for the committee in terms of the decisions that you're going to have to make and how that's going to evolve in the new world under the Fit for the Future and the pooling environment. So firstly, you are still responsible for setting the strategic asset allocation of the fund. And quite rightly, part of the review focuses on that, test the current allocation, looks at some variations that you could consider as part of the review. You'll also have to engage with LGPS Central on the implementation of your strategy. So again, another part of the review that I'm going to touch on first looks at what are the potential areas of priority that you should be thinking about as a committee, and engaging strongly with LGPS Central as they look to take on more of the responsibilities for implementation. The kind of third area that you're going to be responsible for, or still responsible for, is setting your views and approach to responsible investment. So again, we've got a refresh on that to make sure that's properly aligned. So again, so you can communicate that to LGPS Central. And finally, you are responsible under new guidance of setting a strategy to local investment. So again, we've got some slides running through how you can develop your strategy. And again, so you're in a good position to communicate that to LGPS Central. So I'm going to pick out some highlights as we go through the slides and the presentation. Is there a page now? Yeah. So I'm going to jump over the exec summary and the market background. I suppose the key points from the market background is, markets have done very well in recent years, but that is creating pockets of pressure in terms of valuations, volatility, and you won't be able to miss the geopolitics and the impact that's having markets at the moment as well. But the start point I was going to delve into, so this, in terms of focus on implementation, we cover 3 separate areas. So look at your listed equity allocation, your allocation to target return solutions, and your allocations to investment grade credit. So we start with listed equity. The slide here shows the current mix of approaches that you have within the strategy. And it's a mix between passive index tracking solutions that gives you a very cost-effective way of capturing the market return, some active solutions or ones with kind of factor-tilted approaches through LGPS Central, and approaches that also capture some of the emissions trajectory and your net zero objectives as a fund. So overall, it's a blend of active and passive. There's strong characteristics in terms of the climate tilts within there, that should evolve over time as the world reduces emissions, that portfolio should follow that trajectory and achieve your objectives there. And you have a kind of slight focus on UK relative to market cap. So again, we think that is a nice balance that you've got at the moment, but at the moment you're currently slightly overweight to your strategic target to listed equities. If we then go to the performance across the different mandates, overall, I think it's a pretty strong story. Markets have done very well in recent years, so your index tracking solutions have followed the market and produced very strong, both absolute and returns broadly in line with the benchmarks, as you'd expect. The one that hasn't done so well is the actively managed solution with LGPS Central, and that blends a mix of active styles together. And the challenge has been with the rise of the Magnificent Seven, that really concentrated push within markets. When you blend different active managers who take overweight and underweight positions relative to the broader market, for them to be net long those Magnificent Seven stocks has been a very big call to make. So effectively, you've been kind of consistently underweight and not kept up with the market within that active solution. However, that is broadly within our expectations of the managers are doing what we'd expect in terms of following their stated investment styles. It just meant it's been quite a tough market for the active managers to achieve that. Over the short term, so you see the last 12 months have been a bit painful. Longer term, you can see that gets closer to benchmark. So it has done what we'd expect, but I say it has been a tough time for that. But overall, strong performance across the majority of the mandates. Next slide just goes into a bit more detail and kind of highlights the points I've just made. So you have this blend of approaches, but you have effectively had that persistent underweight to the Magnificent Seven. But again, we understand that it's consistent with the styles and philosophy, and we know that's something that's kept under active review by LGPS Central. We've got a few slides on current market risk, and this is just things I've touched on in terms of some of the strained valuation positions, particularly in the US. However, earnings growth does remain strong in the US, but it's how long can it persist and continue to support those valuations. So a slight note of caution on equities in general, but particular pockets of pressure, particularly when you look at the US. So in terms of our conclusions on the equity mandates, We think you do have a nice mix in terms of a blend between active and passive and climate-focused solutions, but we do think this is a priority for review going into 2026. As LGPS Central look to develop their solutions and their approach to implementation, we think it's a good opportunity to put that on the agenda for officers, committee and Central to work together to think about whether you still have the right balance within the equity mandates in terms of regional allocations, styles and the climate objectives that you build into that. So that's a kind of first conclusion, just recommending a review of the equity solution as you go into 2026. The next area I'll touch on and review is target return. So there are a whole raft of approaches to investing in target return strategies, some where you invest in more of a blend of traditional asset classes, equities, bonds, alternatives, others where it's more derivative focused, taking long and short positions and be more complex to understand and implement. And the focus of the fund has been on those kind of multi-asset type solutions, looking to generate a return of cash plus 4% in aggregate. And again, you've had a blend of approaches, one under Ruffer, one under Fulcrum, and a 60-40 split between the two. And again, that was subject to review in 2023, and you've had that balance between the managers since then. In terms of how that looks at the moment, well, in terms of where you are relative to target, you're pretty much bang on your target allocations, both at a strategic level and across the two mandates that you have. So that's been positive. In terms of performance, it has been a more challenging period. So Fulcrum have done extremely well over the last year and since their inception in 2023. Ruffer have had a more challenging time, particularly over kind of 23, 24, given they had taken quite a defensive position and the markets have clearly rallied quite strongly over the last few years. So I suppose that the question is, have they been doing what we would expect them to do? And are we happy holding those managers out into the future? So again, Ruffer, I say, we understand the rationale for some of the underperformance over the last few years. I say they did get caught out a little bit in some of their defensive positions, but also where they decided to take some of their higher risk kind of growth positions, which was more concentrated in China, which really didn't do as well as the US over the last few years. What we have seen, though, positively is some of their risk positions outside the US have been performing better in the recent period. So in the last year, they've started to perform a bit better. And to really simplify Ruffer's approach, they quite often phrase it as investments in greed and investments in fear. So things that will do well in adverse market conditions, but things that will still do well if markets rally and there's growth. And it's blending those different investments that's the key part of their investment strategy. So again, we're still comfortable that they're doing what they should be doing, and we're glad to see performance picked up in more recent times. The other things that these mandates are supposed to do is have a lower correlation with equity markets. So in equity markets are more volatile, provide that diversification and stability in the strategy and the returns that are achieved. And again, some of the kind of highlight numbers here show that the correlation of these mandates has been fairly low relative to equities. You can see it's kind of nearly zero in a couple of cases, or kind of 0.2. So again, that's exactly what we want these mandates to be doing, providing that diversification away from equity markets and stabilising the overall fund's returns. The other thing that they're designed to do is provide downside protection. And again, relative to broad markets, we think that these have held up relatively well in providing that protection when you do have market sell-offs. And given our caution about where markets are at the moment and where equity market valuations are, we still think it's an attractive thing to hold at these at this point in time, given the uncertainty. So again, the kind of focus and the recommendations here is it is not an urgent area to review, given you reviewed in 2023. We believe it should remain a key part of the strategy, and it is one to engage with LGPS Central, because under the government's new framework, targeted return is not one of those 9 asset buckets. There is one called Other that we think this is going to fit into, and I think that's where LGPS Central see it as well. So again, I think this is on the to-do list, not urgently, but as you move ahead, think about how LGPS Central developed that other solution and where the target return solutions fit within that. The third area in the kind of higher level review is investment grade corporate bonds. And again, the reason you hold this is to provide some funding stability. So it gives you a bit of duration interest rate exposure. It also is expected to give you a higher return than government bonds through that additional credit risk that you're taking. The other thing is it provides a kind of stable income stream, and again diversifies the strategy when you blend it with the equities, target return, and other asset classes the funds invest in. So again, quick overview of the current strategy. So you have two different solutions that you invest in. You have one with Aegon, which is a kind of shorted dated credit solution with a kind of climate focus. And then you have the LGPS Central Investment Grade Corporate Bond Fund. The allocations here overall is kind of broadly in line with target, marginally below. A bit of a shift in terms of where you're relative, but that has been addressed, I believe, in January through some allocation of cash, which was agreed at the October committee meeting last year. Recent performance has been a little bit mixed. Aegon not doing quite as well relative to their benchmark, but longer term, certainly the 3 years, they both still performed well. Longer term, a bit weaker from the mandates as Aegon goes back to some kind of tougher times through the I suppose 2022
that's what we added.
The mini budget and some of the turmoil that we saw through markets during that period. So in terms of thinking about credit, I suppose one of the challenges I've said, valuations are very tight in equity markets. In credit markets, they are also extremely tight. So the overall yield you're getting on corporate bonds is actually quite attractive given where government bond yields. But the additional spread that you get on top of government bonds for that kind of credit premium is pretty much at historic lows. So if you see the kind of top right-hand chart, that light blue line is pretty much as tight as it's been in actually going back in history. So it's whether you're still being rewarded for that risk. So it's a bit of a note of caution when we think about the allocation that you have to investment grade corporate bonds. So what does that mean in terms of thinking about allocating to credit? So we think that raises some good questions in terms of how you invest in corporate bonds and the different types of approaches that you can choose to invest in. So at the moment, your approaches are on the right-hand side. So it's active managers that look to take active decisions in terms of what individual bonds they take. Do they take interest rate risk positions? Do they take relative positions on a kind of stock or regional basis or sector or regional basis? The kind of extreme on the left-hand side is the passive approach. So again, just holding all the bonds in the index and the index weight. So that can be attractive like equities and just capturing the return premium in a really cost-effective way. I suppose the slight issue with bonds is if you follow that, unlike equities, and bond side, it means that you are investing more in the more heavily indebted companies. So if you just follow an index-based approach within bonds, you're kind of loaning more money to the companies that are borrowing more in the market, which might not necessarily be the best way of allocating to credit. So what's interesting, and this is a solution that LGPS Central have been offering, is a buy and maintain approach. So what does that do? So it almost ignores the index and thinks, what bonds do I think are the most attractively priced, that I think are the least likely to default? And I'll buy them and kind of hold them up to redemption. It's not called buy and hold though, it's called buy and maintain because the manager still monitors, changing market environment. Does the outlook for some of these companies change over time? In which case I might want to sell out some of the holdings if I'm worried about defaulting or some of the credit risk. So it's a little bit in between active and passive in terms of it's much more lower turnover, but it's less benchmark focused and thinks about bonds more on that absolute basis of if I invest this money, loan money to this company, are they going to be good for it and are they unlikely to default? So again, we think it's an interesting approach as part of an overall investment grade credit allocation. So again, just added some more in terms of the LGPS Central solution. So it's majority kind of UK credit, but also invest kind of 40% outside. And is kind of building the fund size of nearly £1 billion to date. And no doubt, I don't know, we expect it to increase with influxes of new partner funds in due course as well. So again, in terms of priorities for this year, we think it is a good time to review the allocation investment grade credit. I see within the new Fit for the Future, credit is one single bucket. So again, I think it merits some attention in terms of the implementation of that, and an opportunity to look at some of the solutions like buy and maintain. And again, we just had an outline of a bit more detail in some of those alternative options within the credit space as well. So that was the first of the kind of 4 appendices. Don't know if you want to pause there, Vilesh. Yeah. So happy to take any questions at that point on the kind of high level review and areas for priority.
Okay, we'll take some questions now. So Dr. Bloxham and then Councillor Denny.
Thank you, Chair. Thanks for that. Really, really interesting. Lots of good stuff there. I've got a few questions. A couple of them come out of that, but might be better answered maybe by Ian or Declan, but I'll start with the more investment-y stuff. Just the bit about the in the equity section where we've got a mix of active managers, some taking defensive, some taking more aggressive approaches, and they've not performed that well, which is, that happens. But is there a danger that they're just cancelling each other out with these different approaches? And then we're paying extra fees to have active management. And what are we actually paying for there? Would we be better off just ditching that whole active side completely in equities and not paying the fees if we're not getting any outperformance for it? And then a similar question about the bond bit. Where we've got the active, the buy and maintain, and the passive. And I just wonder, well, 2 things. The active, it says the outperformance is generally 0.5% to 1%. Does that include charges? And if it doesn't, what are the charges? So is the actual outperformance less than that? So again, I guess it'd be a question of do we want to be paying for that if it's not much out, if we're not getting anything for it? And then also about the passive, do they have to just track an index? I've never used passive for corporate bonds or anything, but in equities, you can get passive trackers that don't just track an index. You can get ones that only track the highest dividend shares, for example. Is there something similar in corporate bonds which would avoid that issue you talk about where you're just going to be overweight in the most indebted companies? So sort of smart tracker. So I guess they're the investment questions.
Can we just
shall I just stop there?
Should we just take those first?
Okay.
And then if you've got an additional question, David, are you taking these? Thank you.
Yeah, although Louis might want to come in as well on one of them. So in terms of the active equity solution, yes, there is a risk if you take active managers, blend them together, you just end up with a benchmark and paying active fees. But that's part of the role of LGPS Central and identifying different styles that they think will complement each other, so you still benefit from the active stock picking and generate that outperformance. But you need to review that. It's absolutely, it's had a challenging period. But I think if you had a single active manager, the majority of active managers on their own are going to have underperformed in the current market conditions. There'll be some that have done well, but they must have had some pretty punchy calls on the Magnificent Seven to achieve that. So there is a risk when you blend active that you could end up with benchmark, but that's why you need to carefully analyse that, review the mix of managers, and again, that'll be something that LGPS Central will be doing to make sure that you're not just paying active fees and getting passive returns, or as you've seen.
But is the evidence there that that's working? And then presumably we're not just paying for the active managers, we're also paying for the people to review the active managers.
Dr. Bloxham, if you've got a further question, you need to come through me. Can you just let David answer and then Louis, and then you can come back afterwards? Thank you.
Yeah, I think these approaches can be shown to work. The last 5 years, probably not. No matter which blend of active managers you picked, I think they will have struggled just because the narrowness of the market. But over longer term, our research team have a kind of bunch of rated managers that we have rated picks. We've shown that it is possible to pick active managers that consistently perform, but it's not easy. And I've some clients that just say we can't make that decision. We'll just go fully passive. And others where they still have that conviction and will look to allocate to active. So it's about reflecting what you believe as a committee. And at the moment, you do have a nice blend, I think, of the passive index based.
It's the only active is 20%.
And the active, as Bill said, is kind of a smaller proportion within that to reflect that. It's where you're taking your active risk.
Okay, thanks, David. Louis, did you? Is there a point about Central you wanted to Is that, no? Okay, thank you. Bullish, did you want to add anything? Okay, do you want to take that now then?
So yeah, the bonds, so they will apply. I don't have the fee information to hand, councillor, but I think it'll be something like 20 to 30 basis points. You'd probably pay.
We don't say how much, but
Oh,
yeah,
no,
we
public,
keep- yeah.
so there'll be an additional fee that you pay on top of that. Clearly, it's been a bit mixed in terms of performance, but I do think there are drawbacks to investing passively in bonds. Your other solution, are there other index-based solutions that can be constructed in a different way? Yes, although they're a bit rarer within bonds than equities. So you can get things like, equally weighted indices, but they can have much higher turnover costs that incur additional costs because you're constantly having to trade the underlying holdings as well. So yes, you can look at alternative solutions, but they're a bit rarer in bonds than they are within equity markets as well, which is why I think that's a good area to look at in the current review. I think buy and maintain though is quite an attractive one because it's much lower turnover, it's much more benchmark agnostic, and it's just about finding bonds that you're pretty sure or you don't think will default and benefiting from the credit premium on instead.
Okay, thanks, David. Dr. Bloxham, did you want to add a further question or point?
Thank you, Chair. So the other question is the one that's I was talking to you earlier about. Paragraph 5 talks about the funding valuations that happen. I noticed as well in item 9, it talks about the triennial review and then just mentions as an aside they can be more frequently as required. Looking at the local government pension regs 2013, 64A, there is an option for employers to have interim funding valuations. And I just wonder if employers were interested in doing that in the current markets where the MSCI world's gone up over 20% since we had the last one, and we're already at 140%. So this is not really a question about whether that's prudent or not. It's more a question of what would be the mechanics of an employer asking for that. And I know MHCLG are not keen on that, but they haven't changed the regulations yet. How likely is it that we could achieve that? So again, that might be more for Declan and Ian.
Okay, thanks, Dr. Bloxham. So who wants to pick this up? Declan, did you want to pick that up? Or Ian?
The FSS, which we're consulting on at the moment, is putting more information as to what an employer sort of stages that would require them to trigger a look at a review. I would hope that wouldn't necessarily be required because we've done a good, thorough job on the FSS now. And I feel that we've been fair and reasonable in terms of way we've done the valuation and the rates that we've provided to the employers. I think from memory, but I'd have to read the reg, I don't think investment return alone can allow a trigger of this, I believe, but I'd have to read the regulations specifically. But if an employer did feel that they needed a review and they wrote to us, we would obviously liaise with that employer and work our way through it. Declan?
No, absolutely is one of those. You have to take the cases on their merits. The only thing I'd probably add is that because the reviews take a long time, we're only 2 years away from the next review sort of starting. So it always does feel kind of quite loaded against those midpoint reviews just because, the sort of almost the conveyor belt nature of these reviews, you're never that far away from the next one. They're quite a significant undertaking.
Right, thanks for that. So we're going to move on to, has anybody else got any questions or points? Simone?
It was just a point about the stabilisation mechanism as well, and even if that review was to happen, we would still look, I think, to apply any stabilisation mechanism, particularly for the stabilised employees. I think we said, I think that would just be another layer of consideration.
Okay, thanks. Right.
Just a quick one. Given the markets as they are and the fact that the dollar is as value it is, we're looking at investments that have done so well in America, but how do you offset the value of the dollar if you ever wanted to achieve those results?
So the fund does take currency risk. So we do have dollar denominated investments, but we also have a currency overlay. The benchmark position is that we hedge around 30% of our foreign currency, especially the dollar, because it is the biggest overseas exposure. So at the minute, well, you know, if the dollar is moving out to 140 as it is, that currency hedge will be gaining, whereas our investments, which are denominated in dollars, we will be losing. So we're stabilized, if you like, a little bit.
Okay, thanks for that. Okay, can we move on to no further questions on this part? We'll move on to the next section then, please. Thank you.
Thanks, Chair.
Before you do, can I just remind all colleagues that if you have points or questions or any responses, it's through the chair of the meeting. It's not an open forum discussion. I just want to remind people about that. So we do get, you know, proper structure to the meeting. Otherwise, you know, you may as well not have me here. So just want to make that point. Thank you. So carry on, David. Thank you.
Thank you, Chair. So the next presentation covers, I suppose, Appendix B, which is the kind of higher level review of the strategic asset allocation and supported by some asset liability modelling. So again, I've kind of jumped through a couple of points. So starting with, I suppose, where we've got to as part of this review, it does reflect, you know, a very positive position in terms of where you've got to from a funding perspective. You see that surplus figure as you go from the 2019 valuation be a red negative number to be a strong positive number. So again, very healthy position, you know, 140% funding level when we look to review the investment strategy. And this is always a balance of how much investment risk do you take on one hand and the contributions that are coming on the other hand to fund benefits. It's always the two that have to work in tandem. The other point I just kind of highlight, and this is something Bhulesh mentioned, is some of that improvement has been due to the discount rate, and that's the kind of future expected return on the investments. So again, that has gone up, which has helped reduce the liabilities to some extent, but it also means it's a kind of higher bar for future returns. So again, very conscious, although you're in a healthier position, the expected return has gone up. So it's a kind of higher bar for your investments to meet in order to maintain that funding level as well. I think Richard earlier on described it, you know, that's not banked. We still need to generate that return with the investments as well. Sorry, click back in. So flicking to the current investment strategy, as we outlined, you have this mix of growth, income and protection assets. So the growth, listed equity being the main return driver there within that allocation. A broad range of diversifying income generating assets. But as you can see, you're still building towards the allocation there. So overall target 38.5, and it's currently sitting just over 30%. The nature of those investments means it just will take time to draw money, get it invested and get you up to the target allocation. And then the protection assets kind of down at the bottom, where again, you know, providing some stability. But the main bit that's overweight there is actually the kind of cash holding where you're waiting to fund some of those alternatives. So again, a balanced strategy, a bit of a mix, and it's part of this work is to review, have you got the right balance, or can there be improvements in terms of the asset allocation? And Bhulesh mentioned some of the changes that have been made as part of the previous review. So I'm going to touch on some of the asset liability modelling. So some of you might be familiar with this, some of it might be new, but basically we take the liability information from the 2025 actuarial valuation. So we know what the liabilities are paid out to members out into the future, also based on assumptions about longevity and how long people will live, inflation, interest rates as well. But then we also project out the assets based on financial models about what we think equities will do, what we think bond markets will do, and project that out into the future 5,000 different times within the model. Note of caution, there are appendices. Your models are always based on assumptions. These are regularly tested by our firm and recalibrated for the latest information. But again, you need to acknowledge there's assumptions underlying this. So we also test as part of this a couple of kind of key metrics. So one is the likelihood of success. So you're 140% funded now, but how likely are you to still be 100% above 100% funded out into the future? Or in fact, you'll see one of the metrics still above 120%, because actually if you're 140% funded, the likelihood of just being 100% funded is maybe not great if it means you've lost 40% of the funding level. So again, we've applied some kind of higher kind of metrics as well, higher benchmarks in terms of assessing the effectiveness of the current strategy. Although I'm an investment consultant, I am an actuary by training as well. So not the pension specialist. We can't stop thinking about risk. So again, we think about it in a couple of different ways. So one metric that we looked at as part of the review and the actuary evaluation is this risk of regret. And that's the risk that, at the next valuation date, based on different contribution rates, what's the chances that actually the funding basis, the level of prudence that we applied now doesn't basically hit the mark at the next valuation, and there's a risk that we might have to increase contributions from the rates that were agreed at this point in time. There's another risk that we look at as a more extreme kind of downside risk, the kind of bottom 5%, worst 20% of outcomes. What could happen then? How bad could the funding level get there? And compare that for your current and various alternative investment strategies. We've added a couple of slides here in terms of the kind of background to the review. That some of the things that we've also looked at is potential allocations to index-linked gilts or gilts. And these would have been what would be viewed as kind of traditional de-risking steps to move money into these assets. And I suppose over the last decade, they've been a little bit unloved by local government pension schemes because their key role that they play is to provide exposure to interest rates, which kind of stabilizes the funding level because your liabilities, the value of that will move around with gilts and bond yields. But index-linked gilts also provide you that direct inflation protection, so match up with your liabilities, which are also inflation-linked. The reason that you hadn't been holding so much in them is that the yields on government bonds and fixed index-linked gilts were very low, and you're also thinking about affordability and generating a positive return for the fund. But what we've seen now is with the rises in gilt yields over the last few years, your index-linked gilts, current market view, are having a real yield over the 10-year point of 1.7% per annum. So again, much more attractive in terms of the yield that they're generating. And effectively, it would be nice to have a totally risk-free asset that can generate that kind of long-term real return and reduce a lot of the volatility. We've highlighted some difference between investment grade is that you don't get the inflation protection on investment grade bonds, but they do still offer some of that interest rate exposure and some funding stability. Contrasting that with fixed interest gilts, so again, they provide that duration exposure to interest rates that helps dampen funding volatility, but they don't have the direct inflation protection. Or what they do protect you from is times of deflation. So because they're kind of fixed, they protect you from negative periods of deflation. The other issue is that inflation protection, people are sometimes overpay for that because of the uncertainty around about where inflation might lie. So again, having a mix of index-linked gilts and fixed gilts can be attractive because at times you might be better in terms of the value of fixed interest gilts rather when people are overpaying for index-linked gilts. So again, we just want to set that context when looking at the review. What we've modelled here, or shown here, is the range of strategies that we modelled. And a quick headline is, so from the current, we looked at putting a bit more into illiquid assets. And I suppose if you could view that as if there's a government focus on you putting more on local investments, that's maybe an example of what would happen if you put a couple more % into a range of those alternatives, noting, going back to assumptions, assuming that you can get the same level of returns on more locally focused infrastructure, private equity as you can on kind of a globally focused solution. We then looked at a couple of the de-risking solutions, so moving money from equities to index-linked gilts or credit, and then one where it was more focused on reducing kind of credit risk, taking a little bit of money out of multi-asset credit, which is lower grade quality credit, higher yielding credit, and putting it into fixed interest gilts. So we tested all these through the modelling, and I suppose the headline is maybe a bit of a anticlimax in that there is not a lot of difference in the output from the variations that we tested. But the positive news is it's a very good outcome regardless. The current strategy is in a very good place in terms of that likelihood of success. The risk of regret assuming contributions are maintained at reasonable levels, again, the risk of regret is pretty low as well, based on the rates that you've agreed to pay, which are more kind of in the 20% plus region on the right-hand side of the chart. When we then look at it in a bit more detail, we've again picked out specific metrics, so that likelihood of success based on 100% funding, which is the pink dot, and then the orange triangles are if we set higher bar of 120% funded. Again, those are really high likelihoods of success based on the current strategy and the variations that we've tested. So the nearly 90% chance of being at least 120% funded out in 2045. However, the blue bars are that kind of short-term funding risk in the worst 5% of outcomes, and that shows that even starting from 140%, there's a risk in those more extreme outcomes that the funding level could fall as far as about 75, 76%. So if you think of that full distribution of outcomes, that kind of funnel that we showed earlier on, you know, the median position would be in a really strong position, but you've still got a reasonable amount of downside risk, and it's how we balance that within the strategy. So the first variation here of topping up the liquids showing very marginal difference if you choose to allocate that. So it shows you could support that additional allocation to alternatives. That's not what we're recommending because you're still building towards your current target. So current target looks good, but you're not at there. And so we think there's still scope to build any local allocations within that current target that you have as you grow that over time. In terms of the alternatives that we looked at, the kind of more de-risked options, again, there are some slight improvements here if you look at alternative 2 and 3, but it's really marginal, and I think it's almost getting to the spurious levels of accuracy in terms of the difference between the success or the risk metrics. Alternative 4, again, also pretty similar picture to where you are currently, but there are some structural reasons why we think alternative 4 could be the most appropriate strategy for the fund to consider. So in terms of the modelling, the key message is you're in a very strong position. There is flexibility to make some changes, but there's not an extreme rush to make dramatic movements based on where you are today. Again, we'll look to the risk and return profile. So again, some marginal changes in either expected returns or risk. But again, no strong demand to make kind of significant changes at the current point in time. If I can move on to the kind of summary and the correct recommendations. So we're just acknowledging the fit for the future will require us to slightly reallocate where those different assets sit. I suppose the main one is the targeted return will kind of slot into that other alternatives. But again, this is more a kind of reframing rather than a change in terms of the advice or the strategy. So in terms of the kind of summary, we think the fund is in a really strong position. But we are, aware of kind of elevated levels of market volatility, some strains in valuation, and so we think that the fund could consider a moderate change in strategy, which would be to move 2% from the multi-asset credit allocation into a gilt-based solution with LGPS Central. So again, part of the reason for that is you're currently underweight multi-asset credit, so it's kind of a reallocation of the strategic allocation, so wouldn't require significant transaction costs. The max solution is also being kind of reviewed at the moment. So again, we don't really want to allocate more money to it at this point in time. And we think this has some benefits just from a cash flow management perspective, a bit more liquidity and a bit more balance, as well as a moderate reduction in risk and stability of the funding level as well. And that feeds through into the recommendations that you'll see in the paper. So again, in terms of a health check, we think you're in a strong position, but we do suggest some kind of moderate reallocation from multi-asset credit into a gilt-based solution within the protection allocation as well. And the other thing, although we haven't illustrated, there's a kind of separate paper on it in terms of where local fits. We think there is headroom for around about a 1% target to local across those different alternatives. You could have put an allocation across each individual one. We don't think that's the best solution, and is likely to be, this suggestion is likely to be more consistent with the way that I think LGPS Central will build solutions within local as well. So happy to pause and take any questions there, Chair.
Okay, thanks for that, David. Taking questions now, or to Bullish, did you want? Okay, so has anyone got any questions? Martin?
Yeah, it's a number of slides back. I think it's the first or second one of this second presentation where it talks about diversification. it's the first or second. If we can just turn the text up again, sorry to go back there. Not that one, not that one, further back. Oh, yeah, where it basically, what it was saying was, and I mean, let's not distract from the results speak for themselves for members, officers, investment managers, the whole portfolio bringing together and delivering the returns. They're excellent. And that turnaround from the 76 to the 140 is, and over a sensible period of time and a sensible trajectory, with no bumps in the road, given the financial climates elsewhere. That's remarkable. The one that I was concerned about was where it talked about diversification, and it said, the actual text said, diversification produced little benefit. But the misleading part of that is, certainly for us as members, pressure for diversification in the overall scheme of things is quite high. And when you considering the fiduciary duty to members, diversification doesn't produce little gain. It can produce big negatives with the wrong decisions taken at the wrong time. So I was just concerned around the noise around diversification and being misinterpreted, accepting the fact that the overall figures are really good. I forget which screen it was, but it was one of those that talked about diversification causing little gain, but it didn't really speak to it can have a massive negative impact if you make the wrong decision at the wrong time, is where I'm going.
Okay, thanks for that, Martin. Who wants to take this?
I'll have a go. So I think once you're at the levels of diversification that our fund is at, with the sheer number of strategies, every next one adds less diversification, if you see what I mean, which is why we've been trying to simplify our fund over the last 10 or so years. So we've come down from well over 25 managers to around 20, slightly fewer asset classes. So maybe that's the point that we were trying to get to. We can't actually find the exact bit in there, but like I say, that adding a 21st manager adds less diversification than the 11th did, if you see what I mean.
Okay, happy with that. Okay, has anyone else got any other points they want to make? Dr. Bloxham?
Thank you, Chair. Yeah, it's just that talk about the marginal differences in the projections, but isn't that just because the portfolios you're modelling only have marginal differences anyway? So there's like 4 alternative portfolios, but they're all pretty similar to the current strategy, so they're not going to be that different over time. And I just wonder if it would have been worthwhile modelling a couple of slightly more, I don't want to say adventurous, because you could have a much more defensive strategy and a much more adventurous strategy on there as well, and model those outcomes and see what we get.
David, do you want to answer this?
So when we agreed the range of strategies, we were kind of conscious of, as you'd done a review kind of 12 months ago, we didn't want to kind of make drastic changes in terms of the strategy, because there is a cost of changes as well. So it's mindful of that, I suppose, as an LGPS fund, taking that kind of steady approach to both funding and investment. So yes, we could have tested more marked changes in strategy, but we think this is a more prudent approach of looking at to gradually evolve the solution, reflecting where the current market conditions are. The other reason, typically you probably would have seen more differentiation, even at the levels we've changed here, if the funding level wasn't so high. The higher the funding level is, the kind of surplus effectively masks some of the differences in the strategies being modelled. So again, it's a kind of healthy accident almost, that you're in such a well-funded position that this kind of modelling starts to become a little bit less effective at testing variations in strategy, which is why you still have to apply a bit of a qualitative lens, looking at some of those strategic considerations as well, which led to the view and the recommendations here of looking at where market conditions are, the kind of tightness in valuations, the pressures in the credit market, the more attractive valuations on government bonds, and thinking about some of the liquidity considerations as well that the fund is facing. So there's a combination of, yes, there are limitations to the modelling, but the reviews and recommendations also reflects where the world is, that kind of qualitative assessment, and some of the strategic risks that are facing the fund as well.
Okay, thanks for that, David. Had you got any further points, Dr. Bloxham?
Just to sound a little bit skeptical, and I'm worried that there might be some sort of a kind of bubble-like effect, that the people who designed this strategy last year are the people designing the alternatives this year, so they're probably going to go for the same sort of stuff, and that we're not perhaps getting the full range of options that we could get. But I appreciate your points.
Okay, Rupert.
I'm not sure I followed everything, so forgive me. But yeah, I was interested in this sort of tight grouping of the models as well, and how that. I think you explained that, but then you went on to say that there was only a very slight difference with a de-risked strategy, and I wondered if that was still true when you looked at sort of more extreme scenarios in your modelling. You know, you talked about geopolitical influences earlier on. You know, if you focus on, I suppose, yeah, those more extreme outcomes, does that difference between a de-risk strategy and a risk averse and a risky strategy change significantly?
David.
Thanks. So we can test bigger variations, but the other thing is this has to kind of match up with your funding strategy. And Richard has put in place a discount rate based on a certain level of expected return and a level of prudence. If we go too far in terms of testing then variations investment strategy, it could also cause your actuary to revisit your funding assumptions. So we need to kind of balance the two, that make sure that the investment strategy is still generating at least the level of return assumed by your actuary. So again, the risk is we could have done 20% de-risks into government bonds, and I expect that would have reduced the volatility further. But then we also showed that expected return and volatility table. If you do too big a change, it changes the expected return meaningfully and can cause issues in terms of maintaining the funding strategy that you have alongside it. So again, this is designed to be a bit of a balance, that we've tested on variations that have a meaningful enough impact that we think they're worth implementing for the fund. But again, it shouldn't contradict or conflict with your funding strategy at the same time.
Okay, you happy with that? As you can be, there is a lot to absorb. Okay. Has anyone else got any other points? Roy?
Yeah. We took on strategic high level stuff here, but going down slightly deeper into the equities, have we got any mechanism to encourage our managers to put more into, say, commodities rather than the more risky elements of that market?
Yeah, bullish, yeah.
Short answer, no. A lot of our equities are passive, so they'll buy whatever's in the index. The one mandate that we do have, the equity one that David talked about earlier, is managed by 4 managers. Louis here, he can probably give us some more colour behind it, but those managers will invest in the areas that they want to invest in. Coming back to the commodities point, we do have Ruffer and Fulcrum within the targeted return space who are able to invest in those areas. And I know Ruffer in particular have had a stellar end of the year, as you can probably imagine. Some of the metals have done really well, so they've ended up on a double-digit year. So we do have exposure to it, but we probably have less control over where we get it from within the equity portion of the portfolio.
Okay, right. Just going to go to Nick and then Mr. Piper. Nick.
Thank you, Chair. I support the idea of diversification, because that you're not putting all your eggs in one basket. And if some of our active managers have not put so much money into the Magnificent Seven, well, okay, but the passives have. So you're getting up. If it had gone the other way, then it would have gone the other way, if you know what I mean. We'd have had some cover for that. But when you talk about gilts, and I get the 2% increase in protection assets, I'm generally supportive. But when you say it's minimal risk, is it minimal risk now? It might have been in the past, it's traditionally been, but if UK government debt is now 100% of GDP, when before the global crisis it was 35%, is that, and if you're talking about some of them to 2073, is that a minimal risk? That's just the question.
Okay, over to you.
So it's still generally viewed as a risk-free asset in terms of will the UK government default on that debt, and you would hope that would remain the case till there's more strains there, but it tends to be reflected in the yield that you're getting as well in those government bonds. The reason that it's not a no-risk asset certainly, but the other thing is just the extent to which it will match your liabilities. So because it's got that fixed series or inflation-linked series of payments out into the future, that's expected to match if you think your pension payments out into the future. So again, in terms of providing a low-risk asset that kind of matches your liabilities, I think they still play an important role there. I say the reason why LGPS funds like yourselves kind of had flopped away from that was just the returns were pretty horrible over the last decade. They're now looking at a much more positive position, noting the need for the government to still balance that kind of debt requirement as well. So it's not a no risk, but it still provides, I think, a good match to your liabilities, and it's still viewed as being a pretty risk-free asset in some ways in terms of likelihood of default. So.
Okay with that, Nick?
Yep.
Okay, can you just turn your microphone off, Nick? Louis, do you want to just put your microphone on, yeah, please?
I had a response to that. I agree with everything that was said. Default risk extremely low, and they are definitely seen as the kind of risk-free asset. The additional point that I would make is that they can lose value in any given year. And as you saw in kind of 2022 that Lewis has referenced, when inflation is up and the Bank of England is raising interest rates, gilts, whether index linked or not, are likely to fall in value somewhat. So they're not always going to protect in every environment.
Yeah. Okay. Thank you. I think we understand that. Hopefully, we've seen it happen.
Yes.
So, Mr. Piper.
Thank you very much, Chair. I'm intrigued. You're talking about a minimal change, although you're saying that our present strategy is very good. And you're suggesting going into gilts, which has your colleagues, the other people have said, is not quite as risk-free as maybe they ought. And the return is not quite what you might get elsewhere. But then you also mentioned to make a change, costs money. So really, is the cost of the change to what could be a lower return a good idea?
Okay, that's a good question, I think. David.
So, thanks, Chair. So in terms of the funding for this, we said the multi-asset credit is where the strategic allocation is coming from, but you're actually 2% underweight there already. So we're not going to implement this change, you wouldn't actually need to sell or incur costs. The money's actually been held in cash. So again, very, very low cost to implement this change. And actually buying into gilts, it tends to be pretty much zero spread and zero cost for buying gilts. So in terms of the frictional change, expect it to be absolutely minimal to implement this change.
Okay, so is that because just if I may, is that because the multi-asset credit segment, there aren't the opportunities there were, so it's taken far too long to get invested into that? Is that part of the reasoning behind this, if I may?
No, we've had a 9% allocation to multi-asset credit, but at some point last year, Central decided to implement a review of that fund. We were losing one of the managers, and as a result, we stopped adding to it. So we were at just shy of 7 for most of 2025. This review suggests that we should take that target for multi-asset credit down to 7. So we'll be there or thereabouts, and we'll fund this additional allocation to fixed interest gilts from the cash component, which is the point David's making around we'll have very little costs here, very, very low friction. So we're not coming out of something and incurring costs and going into something.
Yeah, so we're not having to sell anything off to fund it. Yeah, basically, which I think is what your question was. Okay, so Roy, is it a different point? Because I want to...
Yes, thank you, Chair. Yeah, just a quick one. And just to go backwards, really, you said you got a 60-40 spread when you were talking about equities and passive and active. Just remind me which direction that was, which is the 60%.
It's probably a bit more than 60-40, but mainly passive. We've only got, of the 41%, about 12% is in the active component.
Okay, thank you. Right, so we've had a good discussion about this. plenty of information. So the recommendation in the report. Right. Still got other stuff to go. Oh, I'm getting ahead of myself. Right. Okay, we need to press on then because we've got 2 more appendices to go through before we can get to the recommendations. And we've already taken over an hour on this. So it is important, but we do need to move on. Thank you. I think that, you know,
So I'm happy to give a high level summary on this one. So I say part of your requirements under the new world will be to communicate your RI policy to LGPS Central and engage with them on that in terms of how they implement. So the purpose of the paper was to do a bit of a review of your RI policy, particularly around about engagement and divestment. So I suppose the key conclusions are that your approach is fairly well aligned with LGPS Central's. There were some potential differences about escalation in terms of when there are concerns and considerations around RI-related matters. But both you and Central, it's an engagement first approach. So it's about engagement with companies rather than rushing to say we're going to divest or sell out. But some of the points we highlighted were just about how you build in those processes for escalating concerns and how that feeds through into the actions that are taken as a manager. So overall, the review shows you have a fairly well-considered approach to RI, investment, engagement and divestment. There's a few points in terms of how that aligns with LGPS Central and kind of sets out our conclusions there. I'm happy to pause there.
okay. Has anyone got any points you want to raise on this at all? I mean, we are doing a review of our responsible investments policy, which is a separate item on the agenda, but it is something that's going on. Okay. Do you want to move on then, David? Yeah.
Thank you. Thank you. So I appreciate some of you did a workshop on this last year, but a new requirement under the guidance will be to set a strategy to local investment. I won't run through all the slides, but there are a few considerations here. And I suppose if we start with the draft guidance, so you will need to set a clear target. You'll need to define local, which has been a big subject for debate as to what local means. And then it'll be about how you look to engage with Central. You have a slight challenge at the moment that I don't think you have a strategic authority that is supposed to help generate some of the ideas on local investments. So again, that's still a bit of an uncertainty for you as a fund. And also there are considerations, again, fairly contentious one in terms of fiduciary duty as to whether you're happy to accept a lower return for allocating to more locally focused investments. So in terms of where we got to, say there's different ways that you can think about it, the definition, the appetite that you have as a fund, and then how you implement that. Also thinking about how you report back on that in terms of the kind of impact that's you're having through those local investments. So again, in terms of the definition of local, the one thing I'd note is in terms of the current guidance, UK is now viewed by the government as not being local. They view that as too broad a definition. So the one that they are tending to kind of focus around is your pool area. You may decide to go narrow on that and focus on kind of specifically on Leicestershire or investments around about this area, but that seems to be where the government is kind of coalescing around and encouraging funds to think about. But it's interesting that UK has effectively been ruled out as their definition of local. So just highlight that. In terms of which asset classes, again, you could as a fund take specific views on areas of priorities like housing that you'd like to invest in, kind of more housing related investments, or you can invest broadly across different opportunity sets, so private equity, private lending, in order to stimulate the local economy in the local region or I say across the pool area. So again, a choice of local and how you fit that into your asset allocation. The level of risk and return that you're targeting in our key consideration, whether any investment needs to stack up on a par with the rest of your investments, whether it's local or globally focused. Again, a key consideration in defining your strategy. And that will you be prepared to accept low returns? I have not seen many funds to date say they're happy accepting a lower return. But we might have more experience in terms of what the pool is seeing. But certainly there's varying views in terms of what local is and the level of return and risk that people are willing to target as well.
Right.
Yep, Billish, yeah.
I think just to summarise it, what we've tried to do here is we went back to the workshop that we had back in the last year, and we listened to what the committee said, and we've tried to build that into this strategy, if you like, and into the ISS, which will, you know, the investment strategy statement, which we will come on to. And we've arrived at this 1% allocation, but we've tried to be as broad as we can, i.e. it sits across infrastructure, it sits across property, private credit. So all the area and private equity, all the areas that we could invest in, but across the pool area. So we try to be as broad and flexible as possible here.
Yeah, so just to round off, Chair, so we did have these different characteristics or allocations that you can consider. I think it's worth noting some funds may already have had allocations to some kind of locally focused investments. The fund doesn't at the moment, so I think starting with a kind of low target makes sense in terms of building towards that gradually. And as Billy said, in terms of the type of impact, looking at broadly across different asset classes, sorry, just whizzing to the end. We think it makes sense to have a kind of low starting allocation targeting 1%. Starting position is probably thinking about it broadly across the pool area as the definition of local based on the feedback from the workshop. And investing in it, as Billy says, across asset classes rather than specifically targeting your allocations to different asset classes as well. Happy to stop there, Chair.
Yeah, thanks for that. And just if I may just put in a comment as well, is that the feedback from the discussions that we've had with other pool partners, certainly at the lead member level, is that all of the pool members that I've had discussions with is that they all view this as a pool-wide investment rather than we just invest in our own backyard, because actually to do that and to find the opportunities that will give us the rate of return is incredibly difficult. And also you've got the costings and everything else. So to get Central to come up with a product that we can then be in, you know, it's actually quite difficult. So we think that the thinking wide, certainly from lead members who are involved in this, is that, you know, the local area is the pool. And for those colleagues who aren't aware, the pool is a very large part of England, or will be from the 1st of April, probably about, I reckon, geographically about a third of England geographically. So it's a very, very big area. So within that, you know, if all the other pools, local pension funds allocate a similar amount, which is kind of broadly where I think they are, then you know, that'll be a big number overall. So actually then that'll give an opportunity for us to get return. The concerning thing, as you rightly identify, David, is the government making very, very strong hints that we might want to take lower returns in return for doing other things that they wish us to do, that fit in with the government objective, whatever that is. So that's a bit of a concern from my point of view, but that's just me speaking as an individual, not the committee, but others I'm sure will have different thoughts on that. So Louis, did you want to add the pool, your pool bit into that?
I could add kind of where we are currently in our thinking. It's very much developing. So in terms of the area definition of local, exactly, we are coming up with a solution that would be all wide. We are also coming up with a solution for those of our clients that have a strategic authority set up, where they may wish to look at just the area of that strategic authority.
Yeah, the problem is we haven't got one, and we don't have one for
exactly.
However,
the only people that have one that have plans in place is West Midlands.
Yeah,
and East Midlands Combined Authority is in the kind of setup process. So those two we are working with, but everybody else, we're doing a pool-wide solution. Other points in terms of definition, very similar to what you're saying, it'll be across private markets. The risk return will be equivalent to what we can get from a kind of globally diversified private market allocation. So quite a high bar for investment. And I think one of the things that we will need to work with you and other people with is kind of really being clear about what the constraints are around that high bar. So if there's investment ideas that there's of sufficient scale return requirements that come to us, there's a filtering process effectively. I think the target that you've referenced, 1%, is pretty common to what I've been hearing. That kind of small steps, very early days. We've referenced the opportunity set, so I think that is reasonable. Other things we need to think about is working with you on reporting back to you this allocation, the returns achieved on it, and the impact that it has had in the local area, whether that's yours or the wider pool.
Just on that 1% thing, I think that the reason a lot of colleagues, other places, we're all thinking around that level is because this is new. So we don't really want to overcommit and then find we get our fingers burned. So I think, you know, we want to actually find out how this is going to work and make sure it actually does work before we can, because you can always increase the amount later, can't you, if it's proven to work. But
and 1% of the 15 clients is almost £1 billion.
Yes, I'm aware of that. Yes, it's just a lot of money. So has anyone got any, Martin?
Probably something you can't answer, but it is troubling. So adding in the local, fair enough. You know, it's outside of our control. We may have been investing locally anyway, whether you're compelled to do so or not. But my concern, and I support the 1% softly approach to this in the first instance, but where my question's going is there any noise around once the whole process is in place, government then saying you've got to have a minimum of 20% in local, which completely changes the trajectory to what we're on. It's that next step that's troubling me as to what might be coming down the line, but we probably don't know the answer to, but we need to be mindful of, because that might actually happen. Because once, like I say, it's in place, if they set a minimum barrier, i.e. 5%, and we're at 1%, you've suddenly got to change that 4% difference by no fault of your own, because we're in quicksand like we've been before.
Before the officers, if they want to answer this, I can answer that question, that there are political discussions going on, have been, about that with colleagues around the country who've expressed exactly that view. What happened, because, you know, various governments, this government and the previous governments, have said, wouldn't it be great if the LGPS invested lots of its money into local investments? And the concern is that the Treasury decides to ratchet that up, makes it compulsory. Well, it is compulsory. It will be in the new Fit for the Future. But at the moment, they're allowing us to set the amount. But exactly your point, if it then becomes a higher amount, and then that has a material effect on the returns to the pension fund, then the actuarial assessment will have to be looked at, because if that has any negative effect and our return isn't as high, then that 140% funded is going to come down, and that's the concern. You know, there's a concern there. So we've got the fiduciary duty. It's been, you know, I'm sure there are discussions. I know there are discussions going on at a very high level about this, but I suspect the government is going to want to wait and see how it works as well before they start imposing, should we say, more stringent requirements. But who knows exactly? Yeah, it could happen. But that's my personal, and that's the feedback I've got politically about this. But if officers, anyone wanted to comment, why have they got any comment now? Okay. All right, Nick.
Thank you, Chair. Just want to reiterate and support you in what you said about the concern about having a lower return or higher risk. I do not think that ties in with what we want to do at all. I'm clear that my personal view is that we should not allow a lower risk on this bit. A higher risk or lower returns on this bit. This should stand. This element of this 1%, which is a sensible way of dealing with the position that we've got, it should be stand on its own merits.
Okay. All right. Dr. Bloxham.
Thank you, Chair. Yeah, I agree also on the low starting point. Makes sense, be prudent on this. In terms of defining the local, I get that if it's too narrow, it's going to force money into bad investments or struggle to find investments. But if it's too wide, I do think it defeats the whole object of doing it. I don't often agree with Labour, but I think there should be some benefit to Leicestershire from it. And I was interested to hear about the East Midlands strategic area. Is there any way we can do a deal with them and join with them? So it's sort of Derbyshire, Nottinghamshire and Leicestershire to have a sort of bigger than Leicestershire, but smaller than the whole pool, which is a third of England. It seems if we're in the whole pool, none of that money is going to come back to Leicestershire.
So firstly, that's not a question for me, but I will add something to it. There is, this is an ongoing discussion with all our partner funds, and there is some talk of considering kind of soft minimum requirements in different areas, if you like, because we are geographically very spread out, and others have expressed that view very, very early days in where we're thinking on that. But in terms of East Midlands and Leicestershire, I have no comment on that.
So to help you out there, Dr. Boxham, so obviously the regulations on Fit for the Future, I think have they been finalised? No, they've still not been finalised. So there has been feedback from all the pension administrating authorities to the government about their proposals. And one of the issues that we raised, or certainly I've raised, is exactly the point you've made, is you say that strategic level authorities will be able to do whatever they can do. We don't have a strategic level authority, and the only places that do is the Derbyshire, Nottinghamshire and the West Midlands. Currently, obviously, there are certain proposals within the government's LGR plans to bring that forward. That timetable could be that if we go with the published timetable of the government, I believe it's 2028, could be that the strategic authority could be created for Leicestershire. What that strategic authority will be over, we don't have that yet, so we don't know. Could be we're invited to join the East Midlands Combined Authority. Again, don't know the answer to that. So we are expected to get some clarification on that, I believe, by July, before parliamentary recess. That's the government's stated timetable. And so you to be fair, as much as I do on that. I think it is a moving thing at the moment, and it could change. So I get your point, but the problem, the other challenge is that if we just said, right, we're just going to invest in Leicestershire, are there enough assets of the right caliber, quality, investment opportunities? And the other concern is that if you start going micro local like that, you end up with what happened when lots of local authorities went around chasing asset investments, and they pushed the value of assets up because they all went chasing after the same things, and then they've all caught a cold when those assets dropped in value, and that's actually caused. So I'm not saying that's what's going to happen here, because we've got professional FCA regulated investment managers who will be dealing with this. So that's not going to happen, but that's the danger. If you just look just super local, you're then chasing everything else. Yeah, by all means, yeah.
My point was not to go just in Leicestershire. My point was, whether we're in a strategic authority or not, is that we do a deal with Nottinghamshire and Derbyshire pension funds,
that's for the
and we
manager.
see that as our local area. That was the point. We don't need to necessarily be in the strategic authority with them, and it gives us a bigger area.
Well,
that
would depend on other areas wanting to do the same thing, and at the moment, there's no indication that they do.
But can we open talks with them to do that?
Well, there's certainly from the shareholder forum and the joint committee for Central, there's been no suggestion of that at all. I can tell you that. So that's not been raised. Thank you. Roy?
Could I ask a question about the pool, the members of the pool? I don't imagine they're all of the same size, and I wondered if it's a pool-wide issue. Some member in some remote area that's got far less invested in the pool than we have would they be treated as equal partners when it came to where you might invest? Whereas there should be, to my mind, some loading as to where the money's come from.
Anyone answer that? Louis?
Well, in that pool-wide solution, it's about the investment opportunity, sourcing the right investment opportunity that it meets the risk-return criteria, and so on, wherever it may be. Does that answer?
If I may, Chair, it does answer, but it doesn't resolve, if you know what I mean. Depends on, to my mind, if you have comparable opportunities in two parts of the pool area, priority should be given to the pool member that's invested most money into the pool. Point of view.
Well, that's all relative to the the size of the employers in that area, isn't it? And we can't control any of that. Sorry, I can't read that from you.
That's fine. Thank you, Chair. I just wanted to flag. I think we should take this approach. I think holistically too. So as opposed to just looking at the rate of return or the expected risk, I think it's part of our fiduciary duty, making sure that our members who mostly live in Leicestershire, Rutland, have better sort of economic outcomes by investing more in our area is going to be good for them. So we should. It shouldn't just be a sort of a numbers game and trying to chase the biggest number there. Although that is important. And I will also flag, actually, it does concern me that MCA and the West Midlands Combined Authority are considering defining local as just their local areas, in which case, if they do that, we should definitely do the same. Because it's a sort of zero sum there in terms of where we're investing our money. We should certainly be looking at sort of keeping an eye on how that develops. But I would say we should seriously consider investing just in our local region if other pools are going to do the same. If other areas are just going to do the same. Also highlighting the fact that both MCA and the West Midlands have a local growth plan. We don't have a combined authority. We don't have an up-to-date local growth plan, which makes, even if we were in a giant sort of pool-wide investment area, Leicestershire less attractive for investment because we haven't built that catalogue of shovel-ready projects. So it could be that our Leicestershire members' money is going to make people in the West Midlands or Derbyshire and Nottinghamshire better off using our cash.
Okay, I'm not. Does anybody in the officers want to pick that point up? I'm not sure. Declan?
I suppose just to clarify, MCA isn't in the pension fund, so that they have been tasked with, I suppose, finding sort of a growth strategy for the East Midlands, which obviously will help them, but it's not their decision about that sort of how local those investments are. That'll be with the Nottinghamshire and the Derbyshire pension funds, and I think Bullish has alluded to that across Central. They are still looking broader than that. It's just, I mean, to your point, it obviously is advantageous for MCA if they're able to sort of start to kind of show how things could be invested, but that request at some point will come to kind of the Leicestershire fund as well. So the MCA one, I wouldn't sort of overplay the sort of the importance on that, because it is still with the sort of individual funds responsibilities.
Yeah, and if I may, even if we do this across the fund area, at the end of the day, local, there's kind of a two-way play on this. So if, for the sake of discussion, as I understand, there is a opportunity that's identified locally, and we're talking has to be, that, as I understand it, will be able to be put through to Central to say, oh, can we, and I'm just oversimplifying this, okay, but Louis, don't hesitate to drop in if I've got this wrong, my understanding. I understand there's a two-way process. It isn't just about Central coming along saying, we think you should, this is what we're going to invest. There's also going to be an opportunity like this through the strategic authorities. In the absence of a strategic authority, the government has indicated that we would still be able to make suggestions, okay, but then of course they've got to be evaluated, and that could be exactly how that's going to work hasn't been finalized. As I said, it's work in progress. So it could be, so one of the ideas that's been mooted, is being talked about very high level, is about affordable housing, for example. Government wants more affordable housing delivery. How do you deliver a return on affordable housing? It's a problematic area. It's not quite as straightforward as you think. So across our area, there are opportunities that might arise, but where those opportunities are, so there's a market intelligence thing. So there's an opportunity for us to push up to say, market intelligence, this is where there are opportunities. Are you looking at these? And then to look. So it's a two-way. It's not quite as it's not top down, basically, as I understand. Yeah. So go on.
Yeah. And I think, yeah, I agree with you, but I think that identification of opportunities is primarily coming through local growth plans, and that's why the Fit for the Future consultation focuses on them, and that's why it's become a strategy duty for those combined authorities.
Yes.
We don't have one that's ready.
We don't.
Yeah.
But yet.
And even after a strategic authority, it'll still take some time to deliver one.
Yeah.
Which is the risk for us to think about in terms of our duty to our members who live here.
Yeah, but by the very nature, investments are long term, medium to long term, aren't they? Therefore, a number of years. We're not just investing short term for a quick buck. We're investing long term to get long term returns for our members.
The allocation does happen at some point, doesn't it?
Indeed. Yeah.
For the long term.
Right. I'm keen to move on but Roy, is it a different point?
I was just going to support that particular position. Are we, as a committee, in a position to actually make recommendations then?
So
the chair suggested that we or somebody could make suggestions to
market intelligence.
So we do need to put in place a process of how we can work. If you don't, the process is easier if there's a strategic authority. That's kind of one of the things that we're flagging in terms of that pipeline. We are keen to find a way to work with local authorities who do not have a strategic authority, that there is some kind of process and pipeline of investment ideas. Yeah. I don't have any detail on how that might work.
At the end of the day, the government hasn't finalised the regulations. So if the government comes out with a regulation, and once they've finalised those regulations, that might cover off this part and say, this is how you've got to do it. And until we've got that, we don't want to go and invent something and then find we've wasted a load of time and money doing that. But once we got that confirmation of the regulations, as Louis just said, likelihood is we will need to have a process until we have a strategic level authority in place. But at the moment, as I said earlier to Dr. Bloxham, we don't know when that is, because the government unhelpfully won't tell us until July, and they may not even tell us then. So we're kind of lots of fingers in the air, aren't there, metaphorically? So, but with that's what, as I understood it, is exactly what Louis said, is that at some point we'll have to have a process in the absence of the strategic authority, which picks up Leopold's point of how do we then put forward ideas, or how do they gather the market intelligence locally of what are those opportunities at the appropriate level that might be that they can then look into further. Does that make sense to everyone? I hope. Sorry. I've got that right? Yeah. Yeah. Okay, that's great. Thank you very much. All right. Is there any other questions or points anyone wants to raise? Because they're keen to move on, and we have got the recommendation on the table. So I'm going to propose that. So the recommendation is approve the changes to 2026 target SAA allocation as described at paragraph 22 to 28 of the report and summarised at the table at point 28, which includes a 1% initial allocation to local investments across the 4 asset classes: private equity, property, infrastructure, and private credit. And B, agree that the following 2 asset classes reviews be undertaken, depending for listed equity and investment grade credit. The nature of the reviews will depend on the asset class design work Central will be working on through the next few months and investment products available. Any outcomes will be presented to the relevant local pension committee meeting during 2026. I'm happy to move the recommendation. Can I have a seconder? Yeah, Mr. Grimley, thanks very much. Can I have a show of who's in favour? That's anyone against? Abstentions? No, that's agreed. Thanks very much. I'm going to suggest that we have a quick comfort break. If we're back here at 12:05, that'd be great. Thanks very much. Thank you. Thank you. Yes, please. Thank you.
We're live now.
We're now live again. So thanks very much. Welcome back, everyone, to today's pension committee meeting. So we're now going to move on to, thanks for that, everyone. So we're going to move on to agenda item 8, which is an update on Fit for the Future and LGPS central pooling. This is pages 237 to 242 of the agenda, and it's over to Simone to take us through this, and also Louis Paul, who's here from LGPS Central, who has got a short presentation, I hope. Yeah, great. Over to you guys. Thanks very much. Thank you.
Thank you. I'll make a start, and then I'll pass over to Louis to do the central part. So I think we've touched on some of this actually in discussion over the last couple of items, but this is just to update the committee on what we know so far and the progress that the regulations are making as we head towards that kind of 31st of March deadline for the Fit for the Future proposal. So and I think some of this also we did update committee on in December as well. So in November, the government sought views on 2 draft statutory instruments, the first one being the Pooling, Management and Investment of Funds Regulations 2026, and it's those that will replace the current 2016 LGPS regulations. And it's those that will effectively put the Fit for the Future proposals into law at the end of March, which is still the current plan. So they cover things like the requirement to delegate implementation of the investment strategies to the pool, and also for funds to have to take principal investment advice from the pool, as well as a range of other things. There is also the Local Government Pension Scheme Amendment Regulations 2026 as well, and they focus on the governance changes that are required and the governance changes that Fit for the Future proposes. So that's things like the requirement to have a senior LGPS officer and some of the other sort of governance and admin policies that we'll need to have in place. Both of those statutory instruments are making their way through Parliament. We don't yet have a date for that to complete, which is what is making some of the discussion we've had this morning a little bit more difficult about exactly what will happen with some of the proposals. We did then in December have 3 draft guidance documents released by the Scheme Advisory Board. They covered asset pooling, preparing an investment strategy statement, and governance. That was a closed consultation. I don't believe we've had any response back from that yet. So as far as we're aware, the expected date for implementation is still the end of March, but is feeling a little bit tight now for those regulations to complete their way through Parliament. What we have done at paragraph 14 of the report is set out some of the actions that the fund will need to take to make sure that we're ready for that transition process. Those actions don't need to be in place before the end of March, but they're the things that we will need to start working on. The report also includes an update on the shareholder discussions with Central and steps that Central are having to take to kind of prepare for pooling and prepare for the pool to be larger and to take on those new partner funds. We do have a draft business plan and budget for review from Central, and shareholders are going through that now. And there's also a whole host of legal agreements and other agreements that are being updated and will need to be updated as part of those changes. So there is a lot of work, and both for the fund and for the pool over the next few weeks, really, to prepare for that end of March deadline, and then the transition period that will absolutely have to go beyond end of March, I think. There is then a section of the report that does cover Central's update, and I think I'll hand over to Louis now to do that presentation and maybe take questions together at the end.
Okay, thank you. Over to you, Louis.
Yeah, I have a presentation which covers kind of the 4th bit of what I wanted to talk about, but I can just kind of verbally give you a bit more of an update, but basically on how we are working with you and the other 14 partner funds to help you meet the regulation and the guidance. So one of the areas touched on is how we're going to be your principal advisor, so I'll touch on that. Another bit is the delegated implementation, so I'll talk about that. All the assets needing to be with the pool, so I'll touch on that. And then the government has set this template of 9 asset classes, which is the asset class solution design, so I'll finish with that. So starting in terms of being able to be your principal investment advisor. So we are building out a team and capabilities to do this. That team will include 4 client directors like me, typically previously investment consultants, a team of support people we're calling client advisory managers, and then also a client service team. So every client will probably have a client director, a client advisory manager, and a client support person to help them giving strategic advice like you've just received from Hymans and all the other areas you might need investment advice. We are also procuring asset liability model, such as you've just seen from Hymans. We're building the processes and governance that enable us to give all the other areas of advice that we need to. Where we do not have that capability in place, we will procure external support where needed. So that's the principal advice bit. In terms of delegated implementation, this is things like, so it's managing your whole pension fund assets. So things like rebalancing, if you're overweight equities, rebalancing back to benchmark, sourcing the investment cash flows that are required. So commitments for private markets, receiving any contributions and investing them, investing any investment income, or dealing with any outflows needed for operational cash to pay pension and so on. So we're recruiting a team to do that of client portfolio managers and support. And again, we're putting in place the processes and the resource that we need in terms of systems as well to enable us to do that. I suspect that there will be a phased approach for that come 1st of April. So we'll continue working with the officers closely for a long period of time. Other element, all the assets need to be with the pool from 1st of April. So as you saw, I think it was like 40% are currently outside of the pool. We are putting in place a means for us to have oversight over those assets. For private markets, there'll be a prioritization we need to do. So many of them are close-ended, so you can't exit. There's a high cost to exiting quickly, so we're not expecting to exit them, and it's kind of focus on the ones that there is an issue. In terms of public markets, any managers that are not in our funds, we will have the buy-sell decision. We are not expecting, this is really important, we are not expecting from 1st of April to be selling any assets until we have a suitable solution in place and we have consulted with you. In terms of doing the kind of due diligence, investment due diligence over those, we are recruiting internal resource to enable that, and we have also procured an investment consultants research database to enable us to have a deeper understanding of some of the managers that we don't already know well. And then the final point is about the asset class solution design. So the government has set out a template of 9 asset classes, which I see you've used in your latest investment strategy statement that you need to invest in line with. What we are doing here, if you want to go on to the slides, is how do we decide, and this is linked to what David was saying in terms of reviews, things to look at in 2026. How do we decide what our equity proposition looks like, what our credit proposition looks like, what our other alternatives or target return proposition looks like? And so we're going through a process at the moment to decide that. And how we're doing that is in several phases. So the first one we've done, which is basically looking at all 15 partner funds investment and responsible investment beliefs and analysing them. And broadly, there's a lot of agreement on that. There's a few areas where there's less agreement. We are looking at how partner funds are currently invested and mapping them to the 9 asset classes, as you have done, and also looking a bit more granular than that to sub-asset classes. So how much is active equities, how much is passive equities, for example. We've got some design principles that we've set and we've talked to our partner funds about, and we've got some high-level characteristics of those different asset classes. So that bit of work has been done. We're now into this phase 2 bit of work where we're actually trying to kind of play that back to people in various forums and begin to set a bit of a direction of travel, a house view, for example, in each of the asset classes. So in equities, our house view, how much do we have in active? How much do we have in passive? How much do we have in emerging markets, and so on? So we're beginning to develop a house view informed by how partner funds invest currently and their investment beliefs, also informed by, we've procured an investment consultant to provide their research, and we have our own investment beliefs and views and have research backing them up. So we're bringing all that together to come up with a house view. How should equities be invested and why? And then what other things do we still need to consider, and what variations might partner funds want away from that house view? So for example, we might say 50-50 active passive in equities we think is the house view. You might have a strong view that you prefer passive management, for example, and we might want to enable you to express that preference. So we're doing that work, and we're playing that back to partner funds by mid-February. Good. On to the next. And then effectively we're going to take a feedback from partner funds. That's mainly going to be via officers on that, and such that by end March, early April, we will have be able to communicate to you a clear house view in each of the asset classes, and what scope we will have to implement differently to that house view to meet any preferences. Then post 1st of April, as I said, first of all, there is going to be no fire sale of any assets. We will keep anything that you have that is outside the pool, we will continue to hold them with that discretionary oversight rule. We will also then work with you, and this I think will be a committee thing as well, talking to you, training you up on our asset class solutions. So Hyman's highlighted equities, credit, and targeted return as priorities for 2026. We will come and talk to you about our view of those asset classes and what variations we have around them. In the background, we will work on implementing those asset class solutions, and then in due course, we will organise any transitions that are required. Thanks.
Okay, thanks very much.
These are some of the design. I won't go through them. There's some of the principles we're thinking as we design the asset class solutions.
Okay. Has anyone got any queries? Dr. Bloxham?
Yeah, it's just a small one. On the timeline for putting in, it mentions putting in our beliefs, getting those into the thing. We did the survey last month about responsible investment. We're doing a workshop later, as Pauline, item 11. I just wonder when that gets integrated into all this stuff. You know, presumably we get that, we give our preferences then to you. How does all that work?
So we've taken your beliefs, if you like, as we had them at the end of last year. Anything that's changed from that, we will talk to the officers and make sure we input that into the process. I think the aim by kind of April time, we aim to have a pretty good feel for the direction of travel that we want to take and that partner funds want to take. However, we acknowledge that there could be some changes to that over the next 6-9 months or so. So what we want to do is where the areas where we're very confident that there is a clear direction of travel and agreement, we can kind of start locking those in and moving forward with implementing. But if there are some areas where there's a bit of, we're a bit uncertain or partner funds views are changing, then we have time that we will continue to consult on those areas.
Okay, so going to move on. It's basically, this report is to note the report and presentation. So has anyone got any other queries? I can't see any. So can we agree to note the report and presentation? Is that agreed? That's agreed. Thanks very much. So thank you very much for that. So we're going to move on to agenda item 9. I know we've probably covered some of this already, but this is the report on the draft investment strategy statement, pages 243 to 272 of the agenda. And I'm going to hand over to Bulish, who's presenting this report. Okay, thanks very much.
Thank you, Chair. So the current ISS was approved at the pension committee meeting in March 2025. It usually has annual updates, usually minor. We've got points 3 to 6 for a bit of background, and especially for some of our newer members. So all LGPS funds in England and Wales are required to have an ISS. This ISS sets out the fund's investment objectives, how investments are managed, the asset allocation that we looked at earlier with David from Hymans, the approach to risk, and the ways in which risks are to be measured and managed. The primary purpose of the ISS is to achieve long-term returns needed to pay pension obligations as they fall due. Once legislation is enacted, this is the pensions bill which is going through Parliament at the minute, LGPS Central will be responsible for implementing this ISS. Points 7, 8 and 9 talk to the main changes which are incorporated into this version of the 2026 draft ISS. Point 7, as set out elsewhere on today's agenda, there are a number of changes which will impact the LGPS, the fund and pooling, all of which have implications for the fund's ISS. This ISS looks to comply as far as possible with these draft regulations, as well as the draft guidance as it is currently understood. It is expected, however, that more changes may be required following this pensions bill being made into law. It is intended to include these changes for the version that the committee will receive in March 2026, alongside any updates to the fund's responsible investment approach following the RI survey outcomes. The key changes which are included within this draft ISS are at point 9. The ISS references the fund's current fit for the future position, acknowledges that its role will evolve with LGPS Central as they assume more responsibilities. The investment beliefs have been expanded to include preferences, offering clearer direction to the fund's expectations. While the fund will not be able to intervene with implementation, these preferences provide LGPS Central with a stronger steer. The revised ISS also introduces a target and sets out a broad framework for local investment. The approach is intentionally flexible and expected to evolve over time and references the workshop from last year. The responsible investment section has been streamlined and updated to reflect the latest draft guidance and requirements. Further refinements may follow as informed by the RI survey, which I mentioned earlier. Any questions?
Yeah, so are there any points anyone wants to make? This report is a recommendation to note and agree that this can go out to scheme employers for consultation. So I think obviously the final one will come back to us in March for us to agree. I would say if anyone's got any comments they want to pick up with the with Bullish, any points outside of that, you can do. But is generally everyone happy? Sorry. So I'm going to propose the recommendation then, A, that we note the draft ISS, and B, agree consultation with scheme employers. That's been proposed and seconded. All in favour? That's agreed. Thanks very much. We're going to move on to item 10 then, which is the pension fund training needs self-assessment. Pages 273 to 284 of the agenda. Over to Kat. Thanks very much.
Thanks, Chair. So this is the kind of annual report that committee get at these January meetings. So at the end of 2025, members will recall we carried out a training needs analysis based on SIPF's 8 core areas. So that was 39 questions, which we got all members to complete. As at 16th January, 10 of 12 committee members at the time have completed that, and 4 of 6 board members have completed it. We're just asking that the members that haven't completed it kind of complete it as soon as possible, just so we can feed that into the training plan for the year ahead. Also on kind of progress to date since last year's report, within the training policy, members are required to complete the Hymans Aspire modules within 6 months of appointment or approval of the policy. So as of January 2026, 10 committee members are compliant. Looking at progress recently, it's just 2 members have like a portion of a module to complete, and then of course we've got a new member who will have 6 months to complete it, subject as soon as it gets kind of set up. And of course we'll reissue reminders as needed. Looking ahead, we'll issue a training plan for 2026 and 27, which will come up as part of the fund's budget and business planning process. We'll also look at updating the training policy, which will be updated in line with Fit for the Future requirements and what training committee members are required to hold. I'll leave it there, Chair, for any questions.
Okay, anyone got any queries? Mr. Piper?
Hi, yes, thank you, Chair. On page 279, you've got a lovely chart. And across the top, over the green yellow bits, I can't read what the column headings are. Thank you, Chair.
Sorry, yeah, I should have said that this is anonymous version of the training needs assessment. So at the top, it's just LPC or LPB. So it's just determining what's forward. So you'll see, for example, essentially the last four are local pension board members, and you see that they have a lot less knowledge of investment areas because it's less important for them. That's the kind of committee focus. We just ask the questions to all of members.
Okay, everyone happy with that? Okay, I mean, again, as part of Fit for the Future, the training needs is becoming more compulsory. I'll put it like that. It's going to be a definite requirement that all members complete the training that's required. So recommendation is that all members should create the training needs assessment. Complete, I think that should say. Yeah, we can create a training needs assessment. We don't have any. So it's recommended that all members should complete the training needs assessment, if not yet completed, by tomorrow, the 31st of January 2026. Yeah. Everyone happy with that? Agreed. Okay, excellent. Thanks very much. So what we're going to do there is move on to item 11, which is the final substantive item, which is the draft Responsible Investment Plan 2026. This is pages 285 to 298, and this is over to Kat. Thanks very much.
Yes, thanks, Chair. So this is slightly different from what we would normally bring. So normally this would be brought for approval of the Responsible Investment Plan for the year ahead. At the moment, this is for your comments and noting rather than approval, just so we can take that time to consider the outcomes of the responsible investment workshop on the survey outcomes, and then of course the survey outcomes themselves. As members will know, the fund has a long track record of integrating responsible investment into its processes, and this plan builds on those previous versions, as well as the fund's investment strategy statement and the net zero climate strategy. Responsible investment for the fund means incorporating financially material, environmental, social and governance factors into our decision making and acting as an active, responsible owner through voting and engagement with the partners, LGPS Central and the local authority pension fund forum. So nationally, as kind of, I guess, Fit for the Future has been, I guess, discussed quite a lot so far, but the Fit for the Future reforms kind of also reflect on the fund's approach to responsible investment. So they emphasise the importance of collaboration within pools and ensuring the effectiveness of engagement undertaken on the fund's behalf, which will continue to be an area of focus throughout the year. Obviously the responsible investment plan says kind of sets out what we're expecting, but I guess just to flag, we're going to have LGPS Central present at the July meeting, and they'll be able to kind of give a more detailed overview of stewardship and engagement and when that's and how kind of financial factors feed into that and are supportive of the fund's fiduciary duty. But I'll leave it there for any kind of comments or questions. Thank you.
Okay, thanks, Kat. So obviously we're just going to be noting this report, but this is an opportunity for members to raise any concerns or any points they wanted to raise. Okay, I can see Vipul, you wanted to raise a point.
Yeah, just a bit of a sort of question based on some conversations I've had with colleagues and other funds. I understand that because of the geopolitical sort of instability happening over the last, won't mention a time period there, but areas have been sort of looking at conflict affected and high risk area reviews just to ensure exposures to geopolitical risks are better and more transparent in a fund's investment. I wonder where that fits in terms of our responsible investment strategy, and whether if there's anything we could be doing locally to find out what our exposures are to those risks.
Kat, do you want to answer this?
Yeah, so I'm aware of conflict affected and high risk areas, and that's a kind of emerging area of something that's developing in across the responsible investment considerations. I know LGPS Central have been engaging on those factors. It's kind of hard to, I guess, create a financial value of how much risk is related to that, just because I guess the majority of the kind of underlying companies that the fund that the managers invest in are kind of such I guess large multinational companies, and so they're kind of exposed to that. But one area I know LGPS Central has been really kind of strong on is engaging on conflict affected high risk areas. So potentially that's an area we can get them to feed back on in the July committee, because they've got 4 themes and one of them's about sensitive and topical areas, and that kind of covers those type of kind of concerns. So yeah, we can feed that in, definitely.
Okay, you happy with that? Okay. Has anyone else got any points or questions, queries they want to raise now? This will be coming back in, so we've got the survey that's been concluded now. Just give us a quick update on that.
Yes, so the survey finished on the 5th of January. So we've had over 2,000 responses, which is more than kind of previous engagement. So we're obviously just working through the responses, quite a lot of text comments, but we'll give some high level overviews to committee on the at the workshop on the 4th of, I think it's the 4th of March. And yeah, the RI plan will come alongside the formal report in at March's meeting.
Okay, that's great. Okay, so committee's asked to, if there's no other queries or questions, committee's asked to note the report. Is that agreed? That's agreed. Okay, thanks very much. So the date of the next meeting, item 12, for noting, the date of the next meeting is scheduled for the 20th of March at 10 a.m. And Kat's just mentioned the workshop on the 4th of March, which is about the responsible investment. So I'm assuming everyone's got that in their diaries. If not, can we just send a reminder out about that? Because maybe not everyone's got that in their diary. That'd be great, thank you. And as I said, item 13, any other items which are decided as being urgent, there aren't any, which brings us to the end of the meeting, and the live stream of the meeting will now end. Thanks very much.